Okay, so let's dive right in. The stock market is right there, knocking on the door of this huge milestone, S&P 7,000. And on the surface, that looks incredible. It looks like a massive win for everybody, a sign of amazing strength. But what if I told you that number is basically a mirage? What if, when you look under the hood, the market is telling a totally different and, frankly, a much more worrying story?
So this is the central mystery we're going to unravel together. We are going to look past that big flashy scoreboard, get right down onto the playing field, and see what is really going on in 2026. Is this a healthy market where everyone's participating, or is the whole thing being propped up by just a few giant companies standing on some pretty shaky ground? Well, let's find out.
All right, first things first. To really get this illusion, we have to understand how the main character in our story, the S&P 500, actually works. Because, believe me, the way it's built is the key to this entire mystery. Now, we all hear about the S&P 500 every single day, right? It's the benchmark. It's supposed to tell us about the health of the US stock market and even the economy. It's designed to give us this quick snapshot of how the biggest companies in America are doing. But it's how it calculates that snapshot that changes the entire story. And this right here, this is the crucial piece of the puzzle. The S&P 500 is market cap weighted. Just think of it like a basketball team's score. But instead of every basket being worth 2 points, the tallest players' baskets are worth like 10 points. So a few giant mega-sized companies have this hugely outsized impact on the final number. A good day for them can make the whole market look fantastic, even if hundreds of the other companies are actually struggling. And this concentration has gotten pretty extreme. For years, the market's been pulled forward by just a handful of mega-cap stocks that we all know as the Magnificent Seven. But here's the big plot twist for 2026. That era, it looks like it's starting to fade. The engine that was pulling the entire train is, well, it's starting to sputter. And you can see the problem crystal clear right here in the data. Just look at this gap. These few companies, they make up almost 29% of the index's total value, but they only contribute about 19.5% of the actual earnings. Now, what does that tell you? It tells you their stock prices have run way, way ahead of their profits. The valuations are stretched. It's like one part of a ship is floating super high on a wave of hype, while the rest of it is actually taking on water. The whole market has become top-heavy, and that makes for a very unstable foundation. Okay, so let's go a layer deeper. Let's see how this distortion creates this massive split in the market. This is where we really get to pop the hood and see that there are basically two completely different markets operating under the exact same name. So to really see what's going on, we can't just look at the normal market cap weighted S&P 500, which trades under the ticker SPY. We have to compare it to its twin, the equal weighted S&P 500, which is RSP. Now, in the equal-weighted version, a giant like Apple has the exact same impact as the 500th company in the index, and this gives us a way clearer picture of what the average stock is actually up to. Okay, boom. This right here is the smoking gun. Just look at this. The headline index, SPY, the one you see on the news every night, it's down 4% this year. Down. But the equal-weighted index, RSP, the one that shows us how the average stock is doing, it's actually up 1%. Just let that sink in for a second. This is the great divergence we're talking about. It means the giants are falling, and they're dragging that headline number down with them, while the rest of the army, the other 490-plus companies, is actually advancing. Money is quietly moving under the surface, away from those tire giants and into other, healthier parts of the market. There's a technical name for this. It's called breadth divergence. Think of it like a general charging ahead while his army is actually retreating. That's a classic sign of weakness. But what we're seeing now is kind of the opposite, and it's much more sneaky. The generals, the big mega-cap stocks, they're tired, they're falling back, but the soldiers are actually finding new ground to take. It's a sign that the underlying health of the market might be improving, even though that headline number everyone's obsessed with looks pretty bad. So if the headline number is misleading us, how do the professional investors, the big institutions, how did they spot this stuff before it becomes painfully obvious to the rest of us? Well, they have a playbook, and they are looking for some very specific clues. One of the big signals they watch for is something called a distribution day. Now, this isn't just a day the market goes down. It's a day where a huge number of shares trade hands, way more than usual, but the price basically goes nowhere, or maybe even falls a little. Think about what that really means. It's like seeing a massive crowd rushing to get off a cruise ship while it's still docked. It's a subtle sign that the big money, the institutions, are quietly selling off or distributing their huge positions to the public while there are still enough buyers around.
The pros also use these technical tools to measure the market's momentum, kind of like its energy level. One of the most common ones is the Relative Strength Index, or RSI. You don't need to know all the math behind it, just the idea. Think of it like a fever thermometer for the market. When the market gets too hot, too fast, the RSI reading goes up. A reading over 70 is like that thermometer showing a pretty high fever. Now, a fever doesn't mean the patient is a goner, but it's a clear warning sign, right? An overbought RSI reading suggests the market has just run too far too fast and that the buying energy is getting totally exhausted. It's a super common signal you see right at major market peaks, basically warning that a pullback is likely because the enthusiastic buyers are just running out of steam. And all of this, it brings us to the climax of our story. This psychological trap that is being set by these big, round numbers like S&P 7000. These milestones, they are not just numbers, they are powerful, powerful psychological events. I mean, have you ever noticed this? The financial news gets so unbelievably excited whenever an index like the Dow or the S&P gets close to a big, clean, round number. Dow 40,000, S&P 7,000, it becomes front-page news. But there is a really dangerous side to all of this excitement. For whatever reason, our human brains just love round numbers. They feel important, they feel significant. And in the market, these numbers often act like a psychological wall of resistance. As the market gets closer and closer to 7,000, a lot of investors who bought way lower might think, hey, this is a great place to take some profits. At the same time, sellers see it as a natural ceiling. This collective thinking can cause a market's big advance to just stall out right at that milestone. And here is the secret playbook for these big milestones. As the market gets near that number, the media hype just builds and builds. This creates FOMO, the fear of missing out, for everyday investors. They see the headlines, they get excited, and they pile in. And that huge wave of buying creates the perfect cover, what pros call exit liquidity, for the large institutions who bought in way back at 6,200 to quietly sell their huge positions. They are selling into that excitement, handing off their shares to the public right at the top. It's such a classic scenario. It perfectly illustrates Warren Buffett's timeless advice, right? The frenzy around a big round number is the absolute peak of greed, and it's precisely at that moment that the smartest investors, the institutions, are quietly getting fearful and heading for the exits. So after peeling back all these layers, what's the big takeaway from all this? Look, it's not about trying to predict a crash. It's about shifting your perspective, from just watching the scoreboard to actually getting down there and analyzing the playing field. So here it is. Here is your new map. Don't just stare at the headline number. Compare SPY to RSP to see the real story of what the average stock is up to. Watch for the pros quietly selling on those high-volume flat days. And when you see a big round number plastered all over the headlines, be skeptical, not excited. Ultimately, this isn't about timing the market perfectly. It's about having a smarter map to navigate it. And that leaves us with this one final, really powerful question to guide your thinking from now on. The scoreboard, S&P 7000, it can tell you a story, but it's often not the whole story. The real insights, the real understanding, that comes from looking at the players on the field, the divergences, the institutional moves, and the underlying psychology. That is where you're going to find the truth.